Okay, let's dive in. The world of hedge funds, it can feel like a bit of a maze, right? You've given us a whole stack of material here, and honestly, the goal today is just to cut through some of that noise and figure out what really matters for understanding these strategies.
Exactly. It's a complex area, no doubt. So we're going to try and unpack the main types of hedge fund strategies, how they actually work, what makes them tick, the kind of risks involved, and crucially, how they might fit into, say, a bigger investment picture.
Right, because just knowing the names isn't enough. We've got info here on classifications, characteristics, even how analysts try to peek under the hood at the risks.
Yeah, and our mission really is to make these concepts clear, maybe even memorable for you. We want to focus on the key things you really need to grasp.
Perfect. Let's get into it. So maybe starting high level, what makes a hedge fund, well, a hedge fund? How are they different from, say, a standard mutual fund?
Good question. A couple of big things stand out. Flexibility is one. They often use leverage, borrowing, much more freely. And another key difference is liquidity getting your money out isn't usually a daily thing. Investors typically face lockups or can only redeem, say, quarterly.
Okay, so that structure probably allows for different kinds of strategies then. And the material breaks these down into common groups.
It does. You often see them bucketed into categories like equity-related, event-driven, relative value, opportunistic, maybe specialist strategies, and multi-manager funds. It's a helpful starting point.
Because each bucket implies different risks.
Precisely. A strategy trying to make money from tiny price differences using tons of leverage, that's got a very different risk profile than one betting on big global economic shifts.
Makes sense.
So, like, arbitrage might have huge leverage risk, long-short equity could still have hidden market exposure or beta, and things like global macro, while diversifying, can be quite volatile. Knowing the category gives you a first clue about the main risks involved.
All right, let's dig into some of these categories then. Maybe start with equity-related strategies. Seems like a natural place.
Sure. So these are fundamentally about investing in stocks. The manager's edge is supposed to come from picking the right stocks to buy or the right stocks to short, trying to generate alpha, basically.
Alpha meaning returns not just from the market going up.
Exactly. Returns specific to their skill in selection, ideally independent of the overall market, the beta.
Got it. And there are different flavors here.
Yeah, the main ones you'll see are long-short equity, dedicated short bias, and equity market neutral. Long-short is probably the most common.
Holding both longs and shorts.
Right. They expect some stocks to go up, longs, and others to go down, shorts. But they're usually net long overall.
Meaning more invested in the long side.
Typically, yes. Maybe, say, 40% to 60% net long exposure to the market. Success really hinges on picking winners and losers correctly.
The managers might specialize, like in tech or healthcare.
They can, yeah. Some are generalists, looking everywhere. Others focus deeply on specific sectors. The thinking is, in complex areas like biotech, a specialist might spot things a generalist misses. That's where their edge, their alpha, might come from.
Okay. What about dedicated short bias? That sounds like a tough gig, betting against the market most of the time.
It absolutely is. These funds are mainly short sellers. They're looking for companies with deteriorating fundamentals, maybe fraud, or just massively overvalued stocks. They might have some longs, but the main bet is downside.
But markets tend to rise over time,
So it's historically very difficult, swimming upstream. But these strategies can become really valuable in market downturns or periods of high volatility. They can offer that negative correlation when everything else is falling apart. Opportunities can actually increase then.
Interesting. Okay, then equity market neutral. This sounds quite different again.
It is. This falls more into the relative value camp, but within equities. The whole point is to strip out the market exposure, get that net exposure close to zero.
How do they do that?
By carefully balancing their long and short positions, maybe in specific sectors or by market cap. They're not betting on the market's direction at all.
So what are they betting on?
On the relative performance between stocks. Think pairs trading. Long one stock, short similar one in the same industry, betting the price gap between them will close.
But those gaps must be pretty small.
Usually, yes, on a per-share basis, which is why these strategies almost always use quite a bit of leverage. High leverage turns those small relative gains into potentially meaningful fund returns. They tend to do better when the market isn't strongly trending one way or the other.
Right. Leverage magnifies the small wins.
Yeah.
Okay, shifting gears. Event-driven strategies. Sounds like they're capitalizing on specific company news.
Exactly. Corporate events are the catalyst. The two big ones covered are merger arbitrage and distressed securities.
Merger arbitrage. Is that just betting on whether a takeover deal happens?
That's the core idea, yes. When Company A announces it's buying Company T, the target stock price usually jumps up, but often not quite to the full offer price. There's a spread.
And the arb tries to capture that spread.
Right. If it's a cash deal, they typically buy the target stock. If it's stock for stock, they'll buy the target and short the acquirer's stock according to the deal ratio. If the deal closes as planned, they pocket that difference, that spread.
Seems pretty straightforward. What's the catch?
The catch is deal risk. What if the deal breaks? Regulatory hurdles, financing falls through, shareholders vote no. If that happens, the target stock usually crashes back down, sometimes even lower than before the deal was announced.
Ah, okay. So it's not risk-free.
Definitely not. The sources call this a downside shock or left tail risk. It might not happen often, but when it does, the losses can be sharp, maybe minus 20% to 40%.
So low volatility most of the time, but with this potential cliff edge, can they hedge that?
They can try, maybe using options like buying puts on the target, but that deal failure risk is really the defining characteristic. The strategy aims for returns uncorrelated with the broad market and often uses moderate leverage, maybe 3 to 5 times.
Got it. Okay, what about distressed securities? Investing in companies in trouble.
Yeah, companies near or actually in bankruptcy or deep financial stress. Managers buy their debt, sometimes their equity, usually at a steep discount.
Hoping for a recovery or a good outcome from the bankruptcy process.
Exactly. They're trying to figure out the workout value. This could involve a liquidation asset sold off, creditors paid in order of priority.
And shareholders are usually last in line.
Often wiped out, yes. Senior secured debt gets paid first, then junior secured, then unsecured debt, then maybe preferred stock, and common stock is at the bottom. Understanding that waterfall, that priority, is absolutely critical.
Or it could be a reorganization.
Right, where the company survives, but the capital structure gets rejigged. Debt might get swapped for new equity, which again, often leaves old equity holders with little or nothing.
Sounds complex. Can managers influence the outcome?
Sometimes. If they buy up enough debt, they can become active, maybe get on creditor committees or even the board. Others are passive. You also see capital structure arbitrage here. Maybe buying junior debt and shorting senior debt of the same distressed company if they think the recovery values are mispriced relative to each other.
Definitely requires specialized skills. What are the key features?
Very illiquid investments usually. Valuation is tough, often uses mark to model, which can smooth returns. Returns tend to be lumpy, cyclical, usually long biased with fairly low leverage compared to other ARB strategies, can be very attractive early in an economic recovery.
Like that energy crisis example, buying beaten down debt.
Yeah, exactly. A manager might see junior debt trading super cheap, analyze the assets, and figure there's a good chance of recovery, maybe even more value than the senior debt implies. Or they might buy that cheap debt and short the equity. Betting the debt becomes the key fulcrum security in a restructuring.
Fascinating. Okay, next up. Relative value. We touched on this with equity market neutral, but this is broader.
Yes. The core theme is exploiting small pricing discrepancies between related instruments. Could be bonds, derivatives, currencies. Anywhere, things seem temporarily out of whack, and leverage is almost always a big part of the story here.
So, fixed income arbitrage, trading bonds.
Right. Exploiting mispricings in debt markets. Could be yield curve trades, betting on changes in the shape of the yield curve. Or carry trades, borrowing cheap, lending dear. A classic one is buying less liquid, off-the-run government bonds and shorting the very similar but more liquid on-the-run bonds, betting that small liquidity premium will shrink.
What's the big risk there? Liquidity drying up.
That's often a major one, yes. If markets seize up and you're highly leveraged, you can face margin calls and be forced to unwind at a loss, even if your original thesis was right. Credit risk and interest rate risk are also factors, of course.
Makes sense. Then there's convertible bond arbitrage. Sounds even more niche.
It is quite specialized. It focuses on convertible bonds. Remember, those are bonds you can convert into a set number of the company's shares. The classic trade is to buy the convertible bond and, at the same time, short sell the underlying stock.
Why short the stock? Isn't the conversion option valuable?
It is, but the goal isn't usually to bet on the stock price itself. The convertible bond acts like a regular bond plus that stock option. By shorting the stock delta hedging, you neutralize most of the direct exposure to the stock's price movement.
So what are you betting on then?
You're trying to isolate and capture the value of that embedded option, specifically its implied volatility. The bet is often that the volatility implied by the convertible's price is cheaper than what the manager expects the stock's actual volatility will be. They're trying to harvest that difference, that volatility premium.
Ah, okay. So it's a volatility play, not a directional stock bet.
Primarily, yes. And they build portfolios of these, typically levered. The sources mention maybe 300% long the bonds, 200% short the stock, that kind of ballpark.
What can go wrong there, besides the usual leverage risks?
Several things. Finding stock to borrow for the short can be difficult or expensive. That's short squeeze risk. There's credit risk. If the company gets downgraded, the bond component loses value. The option part loses value over time due to time decay, especially if volatility stays low. And, like other relative value plays, sudden market illiquidity or extreme volatility can blow up the hedges and force painful unwinds.
Oh, it needs the right market conditions.
Yeah, works best when companies are issuing convertibles. Volatility is moderate, not too low or too crazy high, and markets are reasonably liquid. The example calculation really shows how, for small moves, the hedge cancels out direct price impact, leaving that vol exposure as the main driver. Right. The profit isn't just simple price appreciation.
Okay, let's broaden out again. Opportunistic strategies. These sound like they look everywhere.
Pretty much. They're generally top-down, looking at the big picture, macroeconomic trends, and trying to capitalize across multiple asset classes, currencies, commodities, interest rates, equities, you name it. Global macro and managed futures fit here.
How do they differ? Global macro and managed futures.
Global macro managers can be discretionary, using their own judgment, or systematic, using models. They trade a wide range of instruments. Managed futures, also called CTAs, commodity trading advisors, are predominantly systematic, rules-based, and focus mostly on futures markets across assets.
What's their appeal in a portfolio?
They tend to be highly liquid, often use significant leverage, and their main draw is diversification. Because they're trading based on different signals or trends than traditional stocks and bonds, they can behave very differently. Managed futures, in particular, have sometimes shown this positive skew or crisis alpha, performing well during market crashes.
So they can potentially zig when everything else zags.
That's the hope, yes. Global macro outcomes can be more varied because manager views differ, but both offer diversification potential, albeit often with higher volatility themselves.
Interesting diversifiers. Then we have specialist strategies.
Correct.
Really niche stuff.
Exactly. Things requiring very specific expertise, volatility trading is one, and things like reinsurance or life settlements are others.
Trading volatility itself, how does that work?
It means treating volatility as its own asset class. Managers use options, VIX futures, variant swaps, instruments whose value depends directly on how much prices are expected to move or actually do move.
Not just managing risk, but actually betting on the level of risk.
Precisely. You could bet volatility will go up or down, or that implied vol is too high relative to realized vol. Strategies that are long volatility can have positive convexity. They can make outsized gains if vol spikes, like in a market crash, so they can act as a portfolio hedge.
But probably cost money if things stay calm.
Often, yes. There's a cost to being long volatility, like an insurance premium. Other strategies might try to capture spreads in the volatility term structure or skew. It's complex, uses high notional leverage, and hard to benchmark.
And reinsurance and life settlements, that sounds really different.
Totally uncorrelated with financial markets, generally. Life settlements involve buying existing life insurance policies from people. The fund pays the ongoing premiums and collects the death benefit when the insured person passes away.
So the fund profits if the person passes away sooner than expected.
Essentially, yes. It requires deep actuarial and biometric skill to assess mortality risk accurately, often trying to identify factors suggesting earlier mortality than standard tables predict. Like the Alzheimer's example, that diagnosis changes the expected timeline. It's very illiquid, long-term, but that lack of correlation is the attraction.
And reinsurance is similar, but for catastrophes.
Yeah. Providing capital to insurance companies to cover risks like hurricanes, earthquakes, again, largely uncorrelated with markets, often accessed via catastrophe bonds or similar instruments.
Okay, one last category, multi-manager strategies, putting it all together.
Kind of. It's about building a portfolio of hedge fund strategies, two main ways: funds of funds, FRFs, and multi-strategy funds, MSFs.
So a fund of funds invests in other separate hedge funds.
Exactly. The FUDF manager does the due diligence, selects external managers, constructs the portfolio, negotiates terms.
What are the downsides for the investor?
Usually less transparency into the actual underlying holdings. It can be slower for the FOFUF manager to shift capital between strategies tactically. There's often netting risk.
Netting risk,
Right.
meaning you pay performance fees on the winners even if the whole FOHEF lost money.
Correct. And you've got two layers of fees. The FOBES fees on top of the fees charged by all the underlying funds they invest in.
Ouch. How are multi-strategy funds, MSFs, different?
In an MSF, all the different strategy teams, the equity team, the macro team, the ARB team, they all work for the same firm under one roof within the same fund structure.
Ah, so it's all in-house. What are the benefits there?
Generally, much faster tactical allocation. The central manager can shift capital between internal teams quickly. They usually have common risk systems, giving a better view of overall exposures and correlations. And a big one. The fund sponsor, the GP, typically absorbs the netting risk.
So the investor only pays performance fees if the entire fund is up.
Usually, yes. That's much more investor-friendly on the fee front. The potential downside is more concentrated operational risk. If something goes wrong operationally, it affects the whole firm.
And performance. How do they compare?
The analysis suggests MSFs have often delivered higher average returns and Sharpe ratios than Fs. They also tend to show higher serial correlation, maybe reflecting smoother reported returns due to internal capital allocation or access to less liquid stuff.
That's a really helpful tour of the landscape. Now, the tricky part. How do we analyze the risks properly and see what they actually do for a portfolio? The material talks about conditional factor models.
Yes, this is super important. Standard analysis might look at average risk exposures over time, but hedge fund risks can change, sometimes dramatically, especially during crises.
So conditional model tries to capture that, how they behave under stress.
Exactly. It looks at how a fund's sensitivity to factors like equity market moves, credit spreads, maybe currency moves, changes depending on market conditions, specifically comparing normal times versus crisis periods.
What kind of insights does that give?
It often reveals that the average exposure hides a lot. A key finding highlighted is that during recent crises, many strategies, particularly multi-manager funds, actually developed significant negative exposures to things like the US dollar and market volatility, the VIX.
Wait, negative exposure, why is that bad in a crisis?
Because in a typical crisis, what happens? Often the US dollar strengthens as a safe haven and volatility spikes upwards. If your diversifying hedge fund allocation suddenly becomes short the dollar and short volatility right then,
It's losing money on those factors exactly when you need protection.
precisely, it means those positions are working against you during the stress period. This conditional analysis showed this was a real issue for many funds. Their diversification benefits evaporated or even reversed just when needed most.
Wow, okay, so averages can be really misleading. You need to know how it behaves when the chips are down.
Absolutely critical. It really challenges the simple idea that all hedge funds diversify all the time. So bringing it all together, how does adding these strategies actually impact a traditional stock and bond portfolio?
The analysis here suggests adding, say, a 20% slice of hedge funds generally helps.
On average, yes. The findings usually show it tends to lower the portfolio's overall volatility, standard deviation, often improves risk-adjusted returns, things like the Sharpe ratio or Sortino ratio, which focuses on downside risk and can reduce the worst potential losses, the maximum drawdown.
So potentially smoother ride, better return for risk taken.
That's the argument, but it really depends on the type of hedge fund strategy you add.
Ah, not all strategies help equally.
Definitely not. Some strategies seem better at reducing overall portfolio risk and improving those risk-adjusted metrics. Things like systematic futures, equity market neutral, global macro, maybe merger arbitrage often score well here, possibly because they have lower equity credit links in crises or are more liquid.
And which ones might actually add more volatility or drawdown risk?
Some of the studies suggest strategies like event-driven, especially the distressed side, and certain relative value types like convertible ARB can sometimes increase the portfolio's standard deviation or max drawdown, maybe because of their binary nature, illiquidity, or leverage issues popping up during stress.
And the multi-manager funds, AFUFs and MSFs.
Interestingly, while they are diversified internally, adding them to a portfolio doesn't always boost the risk-adjusted performance or cut risk as much as adding a well-chosen single strategy might. Perhaps because the diversification within the FOF or MSF dilutes the specific benefit you were seeking from one particular strategy type.
That makes sense. The examples really drive that home. Adding strategy X versus strategy Y has totally different effects on the overall portfolio numbers.
Exactly. It underscores that hedge funds isn't one thing. The specific strategy, the manager's implementation, and those conditional risk exposures are what really matter.
Okay, so wrapping this up, we've journeyed through the diverse hedge fund world classifications, the nuts and bolts of equity, event-driven, relative value, macro, specialist, multi-manager approaches.
We've looked at their unique risks, the role of leverage and liquidity, and importantly, how analytical tools like conditional factor models help us see beyond simple averages to understand their true behavior, especially under stress.
And we've seen how different strategies can contribute very differently to an overall investment portfolio. Hopefully, this gives you a much clearer framework for thinking about this complex but important area.
Yeah, having this structure should be really helpful as you dig deeper. And maybe it leaves you with a final thought. We saw how much averages can hide, how different funds within the same category can behave, especially in crises. What does that imply about the challenge and maybe the opportunity in actually selecting hedge funds? How much deeper do you really need to look beyond the label or the average return to grasp the true risks and potential benefits? Something to mull over.